The Federal Reserve is widely expected to keep rates on hold at the conclusion of its two-day policy meeting on Wednesday evening. Investors will be looking for clues as to when and why the Fed could change its stance on rates. Oliver Blackbourn is a portfolio manager at Janus Henderson and joins me now down the line from London to discuss. Oliver, great to speak to you. Firstly, let's start with what you're expecting from Wednesday's meeting.
We don't think you'll get much in the way of new information from this press conference. You've been through quite a period of change over the last 12 months as the Fed has moved from being in what was more of a tightening mode if you went back maybe 15 months. And now we're very much on pause after a series of rate cuts. They've made this very clear in recent speeches. It seems that it would be quite a high hurdle to change that. And I think there's a potential likelihood that they might be on hold for the rest of this year. The market is still pricing a 75% chance of there being another rate cut by the end of the year. But I think that's sort of up in the air depending on how economic data develops over the next few months.
So certainly in terms of this meeting, you're expecting no change. Is your expectations that we get no cuts for the whole year going forward?
I wouldn't say that we necessarily get no cuts. I think we're probably biased to something that's on hold and maybe one cut. I think we have to be cognizant of the fact that the Fed are likely to want to save some ammunition for the next real significant downturn. We're probably bottoming out in terms of economic data at the moment, unless this epidemic in China really starts to spread. It's looked like a lot of the economic data has stabilised after quite a sort of downtrend over the last year. There are signs around that things are starting to pick up. And you can certainly find quite a few sort of mixed messages in the US. I think for maybe the first time in this cycle, the US maybe looks a bit behind other economies actually.
So it looks like the Fed could increase its interest it pays on excess reserves this week, raising the IOER by 5 basis points. There has been some talk about that. Is that significant, and could that provide a market reaction, do you think?
It's not something that we're particularly worried about. As multi-asset investors, we tend to be worried about the much bigger effects of changes in interest rates. However, I think it's important to understand that the Fed is struggling at the moment to maintain control on interest rates in the way that it's used to. As we've also seen with the balance sheet adjustments that they've had, the balance sheet has shrunk from being sort of $4.5 trillion. It was down to around about $4 trillion. It's now up at 4.2. I think that the Fed is struggling to calibrate the way that it looks to control interest rates now, and I think that's something that's going to continue to evolve over the next year or so, as they've clearly gone too far previously, and really need to sort of get that back under control properly.
So we get the latest quarterly US GDP on Thursday and the PCE inflation, which we know is the Fed's preferred measure of inflation. That's coming out on Friday. So quite a few significant data points for the Fed to digest this week. What do you think it would take from the data to move the dial on the Fed?
I mean, to be honest, I don't think there's, barring a significant collapse, which is unlikely given what we've seen in some of the other numbers. I think it's going to be very difficult to get the Fed to move. On the inflation front, for example, it's looking like that's been bottoming recently. We've had several PCE numbers down around about 1.5. A lot of the rest of the world looks like it's bottoming and starting to pick up. But it's going to take a lot for the Fed to really get excited about a move up in inflation now. We've seen this, it's probably one of the biggest changes over the last year, has been this move towards talking about average inflation targeting rather than just that 2% number that has been what they've had for the last decade. It would be quite a big step away from the way that they've spoken about policy for that for them to really start to worry about inflation until it gets probably somewhere a significant amount above 2% now.
All right, switching focus very slightly to talk more about the markets. I wanted to get your outlook for US equities, because on the one hand, we got rid of some of that uncertainty around the trade war after the US and China signed that Phase 1 deal. But we're kind of weighing that up against the uncertainty around the coronavirus. We know that's been taking its toll on markets, both in the equity space and the commodities as well.
Yes, the coronavirus has come at probably quite a difficult moment for equity markets. If you look at US in particular, it's at 15-year highs in terms of valuation. We're talking about a lot of potential upside in earnings growth now really being priced in. And it's also against a backdrop in which sentiment indicators are starting to make things look quite stretched. If you look at some of the put-call ratios, for example, in terms of volumes, they really look like they're pricing in a lot of fear into the market, or certainly you're losing that sort of upward momentum. And you can look at other indicators such as the bull-bear spread, showing that things are maybe not as stretched as they have been, but they're certainly towards the upper end in terms of sentiment.
And what about your outlook for the US dollar? Because at the start of the year, we heard from lots of analysts which were calling for a weaker greenback. And that was after that depreciation we saw since September. But so far this year, the dollar's really been on the ascent.
Yes, it's maybe been something that's has been an example of what's happening, what's really happened over the last quarter or so, maybe now 4 months. Most of last year, up until September, we had really monetary policy driving things as the central banks responded to a downturn, and that was quite supportive for the dollar. Then we got to the point where even economic growth, the stabilisation in some of the numbers started to come through, and that really sort of started to turn in September. And it turned much more in the rest of the world. And that better growth momentum that came through in the rest of the world really helped other currencies perform better against the dollar. Since the end of this year, the end of last year, you've seen that really start to come under question, particularly the new coronavirus incident or issue in China has put a few concerns back into people's heads, and maybe some of the US data has been better than people expected as well. So it's put a floor back onto the dollar that I think was lacking. And it's really the sort of that relative growth momentum has favoured the US and probably will continue to favour the US, but also the fact that you've got higher yields in US assets. And that's really quite attractive to a lot of investors around the world who are being paid negative rates in many instances.
All right, Oliver, thank you so much for your time.
Thank you.
That was Oliver Blackbourn, Portfolio Manager at Janus Henderson. I'm Victoria Scholar, and thanks for watching IGTV.